So we are going to check on how to understand market liquidity using the ICT and SMC concepts. So what is liquidity? Liquidity represents the pool of orders in the market, crucial for executing large trades without significant price disruption. It allows institutions to efficiently manage their positions, as every market movement reflects their strategic pursuit of these liquidity pools. So that basically is what liquidity can say, in other words, in a layman's language. These are the points, that the highest points or lowest points that our market has been rejecting for quite some times, and they normally have long wicks. They normally have long wicks, so you tend to see that the market goes for those points, takes out those points, then continues with its movement. And mostly the high institutions which are involved in trading, or otherwise the market movers, you'll normally find that they place their buy stops or sell stops at those points, waiting for them to be triggered. As the retail traders are taken out, then they will enter other markets. So what is liquidity? Let's look at how to understand the liquidity, institutional liquidity needs, and collecting liquidity. Collecting liquidity, in other words, is what we call the liquidity sweep or grab or stop hands. Liquidity refers to the pool of orders in the market, typically manifesting as stop losses or pending orders situated around critical price levels. These critical price levels are the swing highs and swing lows, or major swing points of the market, where the market is yet to break or to sweep liquidity at those points. So institutional liquidity needs include exceeding large buy or sell orders smoothly. This necessity prevents sharp price movement and gaps that could occur if these orders were executed without sufficient liquidity. So these gaps are what we call the fair value gaps, inverse fair value gaps. We have imbalance volume. So you tend to find that the market left a gap before opening at 12 in the midnight. So these are the points where there is enough liquidity for the market to retrace, and you tend to find institutions placing their orders at these points. When retail traders set buy stops above resistance or sell stops below support, institutions may drive the price to these levels to activate those orders. So which orders are we talking about? The orders are the stop losses of the retail traders, because you're putting on tight stop losses. So the institutions aim for those stop losses so that they can be activated for them to be profitable. Understanding relative highs and lows, we checked about this in the previous video that I was explaining. This is how defining highs, equal lows, non-perfect alignment, but are perceived by traders as close enough to be considered equal. This perception creates significant interest in those levels, often resulting in price action that draws attention to them. The retail perception, they perceive these equal or relative equal highs and lows as support and resistance for those who use price action. So liquidity magnets, these areas act as liquidity magnets. Those highs and lows, they act as liquidity magnets in that they pull the market towards them so that the market can take out the liquidity. So price near this area tends to reject. You'll see the markets, once it reaches these areas, the candlestick will normally have a large rejection. The price will reject before it breaks this point. So this is inducement. Inducement, in other words, is these are false confirmation, whereby the market tends to come near your order block but does not take out or enter your order block. It just reaches a small point, maybe 5 pips, for it to enter to your order block, but then the market does not enter to your order block or fair value gap. So it gives you a false signal of entering a buy or a sell, but then the market will trace back, take out the inducement and enter your order block. These are the characteristics of inducement. It manifests as a minor price fluctuation, such as small highs or lows near significant levels. They don't really enter to the significant level, but they come near it. False breakouts and trendline contracts. Those who trade using trendline, the market will give a false breakout to the trendline for you to think that the market is reversing its movement. So outcome of inducement, these are the outcomes. The market typically takes liquidity from those trap positions before moving towards the actual institution's target. So the market will form an inducement, you enter with that inducement, the market gives you a false signal, then it comes and hits your stop loss before moving on with the intended signal. Buy-side and sell-side liquidity. This is what we call the buy-side liquidity. We talked about this, so kindly note these key points. Buy-side liquidity is the liquidity generated when sell stops are taken out. So buy-side liquidity is this one. So sell stops are taken out because you put your sell stop here and your stop loss are above, few points above, so it takes them out and continues with the actual institutional move. So we normally find buy-side liquidity in previous week's high, previous day high, equal highs, above daily or higher time frame resistance, or swing highs, in other words, above structural highs. That's external liquidity and the buy-side liquidity. Internally, we find them in the fair value gaps, order blocks, volume imbalance, and trend lines. Sell-side liquidity is the opposite of buy-side liquidity. This is where we find them in the previous week low, previous day low, equal lows, below daily or high time frame support, below structural lows. So institutional maneuvering. Institutions strategically maneuver prices between buy-side and sell-side liquidity zone to effectively harvest liquidity. So they will maneuver, they will tend to respect these zones, mostly for daily and weekly or high time frames such as 4 hours. Institutions will tend to respect these liquidity zones, take them out. The previous day high or the previous week high, previous week low, the institution will come and take their low or their high and aim for the opposite liquidity. Liquidity pulls and their significance. These are liquidity pulls. Price is attracted to visible liquidity zone such as equal highs or close, trendline touches, or order blocks. Those are the where price is attracted towards, because that's where the institutions place their orders. These things we will mostly find them in derivative. If you observe the derivative market, you mostly find these characteristics that we are stating here about liquidity pulls, buy side, sell side liquidity. It tends to observe them mostly because when you look at the other side on the forex, there are other factors that lead to disobedience of these structures, such as news. When there are news or there is a FOMC, Powell is speaking, you tend to see market reacting. It reacts so because the big institution traders get out of the market. So once they get out of the market becomes very volatile during this news time. So these are the practical applications of trades. Identify liquidity pools effectively, observe signs of inducement, wait for liquidity sweeps, combine the market structure. So key points: external range liquidity refers to buy-side liquidity above the range high and sell-side liquidity below the range low in the current trading range. Internal liquidity are what happens inside, such as fair value gaps and the order blocks, which lead internal range liquidity contribute to the external ones, and these internal ones are the ones which give you your entry points. So this is internal, this is external range liquidity. So how internal and external range liquidity works? Internal acts as stepping stones or contributes to external. Price often sweeps the internal liquidity by aiming for the external. Mark that. Now, after sweeping the external liquidity, the market will tend to find to create other external liquidities so that it will go forward and aim for them. If it sweeps the monthly, if it sweeps the daily, it will aim for the weekly. Sweep the weekly, aim for the monthly. Identify internal swing points, highlight external liquidity zone, monitor price interaction, use indicators for confirmation, and combine with market structure for you to find a good entry point. Thank you for that short presentation.